It is Tuesday, the 2nd of September. I'm going to be doing a review of today's trading, which went all right in the sense that I did a few things correctly, but it also, as you can tell, took a loss after having missed or not taken the trade that I'd wanted to take. And there's a good reason for that, and I am pretty happy with my performance overall, mainly because I was patient and specific, and I only took one trade. Both things that, had I not done either of those things, it would have been a lot worse. So this is a new account. My Fun and Futures was doing a $1 account deal, so managed to get hold of one of them, and this is the first trade taken on it, minus $243. But I've decided I'm only going to take one trade a day on this maximum, and I'm only going to be using one framework, and that was this framework here. The idea was that we had a gap down on the regular trading hours. This is Friday's close, Monday was a holiday, and then we opened up the regular trading hours all the way down here on this yellow candle, 9:30. So big gap down. We're also below the 8:30 price, midnight, big discount. And with my specific model, usually what I want to look for is for us to first engineer a high and then entice shorts, and then I want to take that high. So what I really wanted to see, I'll go in more detail soon, but I wanted to see when we opened on this candle, I wanted to see us maybe drop down a bit and then engineer a high and then entice low, and then I would have taken that trade there, taken a long. So I wanted to see it first engineer a high, then entice shorts, and then attack that high. As you can see, we actually dropped immediately without engineering a short-term high first, and then reversed and kept on pushing up. By here, this was like I would have, if I had gotten the trade here like I'd wanted to, I would have been happy with this being the terminus of the trade. I would have held a runner up to here, but that would have been good enough. So when we had gone past that and hit this area up here, already I knew that, okay, well, I've kind of missed it. I should have been in down here, and I learned a few lessons as to how I can prevent this from happening next time. But the reason I took this next trade was essentially that I could finally fit a specific sequence of events that I was looking for. Because I have these written down. I have sequence of events. It's like number one, we engineer a high. Number two, we entice shorts. Number three, we attack that high. It's like a specific sequence, and I decided with this new account I'm going to be disciplined. I'm not going to just take random trades on hunches, and so I actually did a good job by not taking this trade, even though it looks really perfect to me, and there were many confluences which I will go over shortly. Many confluences that made this an A+ setup. Well, it looks like my computer's frozen. That's not ideal. There we go. It's still frozen. Too many drawings maybe, or maybe it's just the recording or something. In case you can still hear and it's still working, there were just a lot of confluences that made this a really high quality setup, and I was very confident in the long all the way down here, but I knew obviously not to just, from experience, not to just randomly buy, and I wanted to be very disciplined in this account, in this new account, because I'm turning over a new leaf basically. I'm going to be just taking one trade a day, and I managed to achieve that today. So that is one of the biggest wins for today. Just one trade, and I know that next time I do catch a trade, I'll be making a good 3 or 4 R on it. That will easily cover whatever loss that was. So I do want to walk through this trade. The only other thing I want to do on this video, after walking through this trade, I won't do it on this particular chart, but this kind of gives you an idea of all the information I was looking at. But I'll do it on a blank chart because this has been too confusing to look at otherwise. But after going through this, I want to briefly go over a gold trade from this morning as well, taken on a different account. And yeah, so to start with, I will load up a fresh chart. These things are annoying, it just keeps popping up. Okay, so the framework, as I mentioned, is when we have a gap lower, then the idea is that anyone who is tripped in on this gap lower, they want to place to trail their stops. That place to trail their stops is going to be this high, it turns out, which we are going towards now. But the idea is as soon as we open, I'm looking for us to engineer a high, entice shorts, and then attack that high. And a lot of the time, if let's say this is the gap down, and we opened right here at 9:30, it didn't work. We opened here, then we might engineer a high like that, and then drop low to entice shorts, and then attack that high. And that's the move I'm looking for, is that long. So that's what I wanted to see here. The other things that made this very high probability, we are hitting a previous week low from way back. So this old previous week low, so clearly we wanted to take that liquidity. Also hitting this major impulse low, there'll be an enormous amount of sell side below that. Both reasons as to why we could expect some sort of a bounce, as well as the fact that I just mentioned that anyone who was short through this entire range, if we look at all these highs, they're all very smooth highs, especially following the post-London sell-off. We barely took out any highs, left smooth highs the entire way down. So whoever's been short all morning, they are still making money. And I'm actually going to jump off the RTH back onto ETH. You can see the gap down. But a lot of the context that made me super confident in this trade actually came from the ETH during the overnight session. To start with, you can see all the smooth highs. We haven't been taking out anyone who was short. A lot of the time that is indicative that we are likely to have a reversal back up. We're leaving smooth highs intentionally. Then we get to this area. So if I grab myself a nice box and go to 8:20. So 8:20 is a key time of day. Can't remember the exact name of what happens then, but something happens to do with orders or markets or something, and it just plays a significant role, but I can't remember what it is. But what I've noticed is that there's a specific framework that I use where 8:30, so a lot of the time 8:30 will do a manipulation type move that will take out a high or a low before an actual move, and it will also act as kind of a fair value discount premium level, similar to how midnight acts. When 8:30 fails to take out in this case, a short-term high, and then just rolls over, then what I discovered is that that becomes a very high probability draw for the 9:30 open. Prior to 8:30, there are also candles, and sometimes there will be a raid at, let's say, 8:22, and then 8:30 will just keep on rolling over, and that actually counts as good enough, and the market never returns. What I've found to be true is that a very, very high percentage of the time, when between the time of 8:20 a.m. and 8:30 a.m. EST, we don't raid any opposing liquidity and we just roll over, that becomes an incredibly high probability draw for the open. So that was in my favor, along with the fact that with the RTH trailed stops model, I'm looking for a long. We have this big sell-off overnight, hitting major sell-side levels. I think that's the previous week low, roughly down here. I'm just going to do it roughly for now. And also this area. So this had a lot of my interest because I've noticed that impulse highs and impulse lows are incredibly nice areas for either raids and rejections, so like a turtle soup and rejection, or for anyone in this range. So throughout this range in here, anyone who's trying to catch the next leg lower, so they see we've been going down overnight, they say, oh, a big drop, I want to chase that. So everyone in this range wants to sell because, we're going lower. And then it starts grinding higher. Where are they going to put their stop? Well, above this high, obviously. So, I know there's an enormous amount of buy side up there. We're just consolidating. Everyone's getting nervous. Everyone's shitting themselves, like adding to their short position. And then at 9:27 a.m. we begin breaking low. Huge sigh of relief. Everyone's happy. Everyone's like, oh, that's great. I'm going to add to my short here. People start adding. And then the market tanks at the open. Everyone's happy. And people think that it's going down to zero. I know that there's biases up here. I know that my framework specifically states that I'm looking for a long. We have all the smooth highs, big gap down below 8:30. Midnight is up here somewhere, way up. And yeah, so all that stuff fits really nicely into why it's a very good idea to look for a reversal down there. The next thing that I had in mind during the open was the fact that we're in very close proximity to 23k. A major institutional level. A lot of the time, price will want to visit these levels, either for the purpose of engineering liquidity, engineering ideas of support and resistance, as well as just probing below it or above it, and often a few hundred points above or below it, to take out any traders or institutions who are using those kind of big figures as place for the orders, whether that's an entry or a stop order, or just that they're trying to accumulate a position there. One of the nuances with them is that when we fail to reach them, that can mean something. Either if, let's say, it might even be an example here, but if we go to the hundreds right here, that's a great example. So the 100's also a big figure institutional level. When we fail to retest it, like on this candle here, we test it there, false resistance, drop down, and then rip up through it. We never come back and retest it. That is indicating that there may not be any intention of going back down to that level, and we can continue. A similar dynamic exists when we are reaching towards the level, but then fail to get down to it, so fail to reach it. And I was anticipating that. I saw that we failed to reach 23k, begin turning around, and right in this area here, I was watching price in the 15 second, looking for a long. So I'm going to go over the execution I should have taken. Obviously, this is absolutely trash. I knew that it didn't look that good, and I knew I had missed the move, so there was no reason to have taken this at all. Also, there's the idea that during this big rally, all AM session leading up to a bullish news candle, we hadn't taken any sell stops in particular. So just the fact that we'd pull back to engineer this low made this basically a framework that I'd look to go short on anyway. So why would I be trying to go long here? But that's beside the point. It's going to be focusing on what the model actually was, and I'm going to try and do it fairly fast. So let's see. Let's use this chart. 15 seconds. To go to the 15 seconds. Another thing on the 1 minute first. This sell side, we have a long wick here. Long wicks look like a bullish rejection. Everyone wants to put their stop loss below that. On top of that, we have these relative equal lows with that one and then that slightly higher low there. When we have multiple relatively equal lows above a really obvious low or impulse low, that's what I have called my delirium model. And the idea is that anyone who likes using support and resistance as a good level to buy it, they're not going to put their stop loss right here. Like, who would buy at support and put their stop loss one tick below? Probably not many people. I don't trade that way, but I'd imagine that if I did trade that way, I'd be thinking, oh no, I'm going to put my stop loss somewhere a bit safer, the strong rejection candle. So the fact that we engineered these relative equal lows just above this really obvious sell side pull with a long wick, that's enticing people to put their stops down there. And by putting these relative equal lows just above it, it shows intent on the market's part to put additional effort into putting even more sell side below this low for the purpose of accumulation. So that's another reason why there's a lot of liquidity down here. So as we drop into these lows, remember that's the previous week low. Don't really need that. I'll move that up to here, so that's that wick now. As we drop down, that's the 9:30 open. That should be yellow, ideally. Oh well. 9:30 open, sells off, consolidates a bit, and then drops into the lows. And then in this area, I'm trying to look for SMT. Initially, there wasn't very much. However, we did get SMT right here, which I'll show. So if I bring that up, you can see that on ES, on this particular low, we took out this swing low. Now this is actually, that candle there is actually the minute open candle. So this is actually just a 15-second, it's only visible on the 15-second chart, but you can see that there is a very clear bullish move, retracement, and a full swing point put in there. If you looked on the 5-second chart, there'd be a very obvious swing point and enticement, then getting raided out. At the same time, Nasdaq has this nice impulse low that we failed to take out there. That was the first clue that looked like it was turning around, along with the fact that we had these, all that narrative I just explained, as well as these trap shorts above all of these highs and above the 9:30 high. The next thing that I was looking at is this swing high. So this is a impulse high, the most recent swing high that made the low. So when we hit that high, if we were bearish, you would want to see a very sharp rejection from this level. So if I zoom in, you can see that we did just tick above that and we got a rejection. That's great. When that happens, you don't want to see us come straight back up. And if we do come straight back up, you definitely don't want to see us push up through it with such momentum. So if you were, that is if you wanted to be short. So that's what I'm looking for. I'm looking for that to unfold. As we pull back in this area, we're also pulling back to the 50s. So as I mentioned, with institutional levels, there are also the in-between levels of the 20s, 50s, and 80s, and I use those in a similar way. But obviously 23k is a lot more significant than 23k and 50, but it still plays out. So dropping below that, when we get to that wick below that level and rally up, that also gives me an indication that we are likely to keep pushing. And then we have the 80 sitting here as well. Those are just minor details, but the main thing is that we'd already hit this high, already rejected lower, and then we ripped back up. Now, the fact that we hit this high with the speed and momentum through it shows intent of going towards these buy-side pulls. Another thing that really stood out to me was the fact that this candle open, so this is a 1-minute candle open, as you can see on the, whoops. So if I draw that across and make that a line. So as you can see on this chart, that's a 1-minute candle open. We opened, 15 seconds, traded down, 15 seconds, made the low, 15 seconds, still remained below that wick. Now we're 45 seconds into the candle, 15 seconds remaining, and what happens? It rips way above the open and closes super strong looking. This is a signature that I call the last second wick, and essentially it's when a wick forms, but the way that it forms, it happens very last second or last minute. Like an hourly candle, the entire long hourly wick may form in the last 5 minutes of the candle. How I use that is usually, as you saw on this one, I use these wicks for reasons as to why we should attack those wicks, because people see that as a rejection. But sometimes it is an actual rejection, and the way I differentiate between those and actually trust the rejection to hold is when the rejection / the wick forms in the final part of the candle. And what that tells me, the narrative in this area is that we started in tight shorts. We spent the entire time looking bearish for as much of the candle as we could, and then very last second, after spending as much time looking bearish as we could, trapping traders short, we then rip up. So the idea is that there are trap traders down here. Once we do that, it shows intent of taking out this high. We have that narrative, and I'm ultra bullish. This became the entry. So dropping down to the institutional level, the 80s or anywhere in that area, that is exactly where I wanted to get in. And that would mean a great entry. So I'll put a little arrow there to indicate a great place to buy. This is a great place to buy, as Trump tweeted on the last major high time frame pullback. Yeah, beautiful rip up and delivers straight to our target. So the next model, and this is another model that I only came across like a week ago or a week and a half. This is building on top of models I already have. So a framework that I worked out exists quite often is the 930 expansion model, which is essentially the idea that a lot of the time the 930 open will form a market maker framework within its expansion. So even if it's not super obvious exactly where it is at the time, you might start seeing us heading in one direction, and then all of a sudden you're like, this is first stage, and then we've got second stage right here, IFED, and runs max new high. But one of the key signatures for first stage of the market maker model is a intermediate term low. So that's just a low that's lower than the other low. And also SMT. So we get that here with SMT. So I'm jumping ahead of myself actually. Before we jump to that, I will go over that soon. But before we get to that, I want to go over this. So as I mentioned, I'm ultra bullish. I know that we've got all these smooth highs up here. Sure, I think 830 is an extremely high probability target, but I think we go a lot higher, especially with the narrative of there being trap shorts below this high. So my next model that I wanted to use is called the impulse rejection failure. So when we hit an impulse high where you would expect us to reject and run lower, the same thing as down here. You would expect us to hit it and just run lower. When we fail to do so and we begin to run lower but then get back above, that becomes a great entry. So right on this candle here, on the close of this candle back above that high, that shows that we were unable to reject lower, and it becomes a M1 impulse rejection failure. Now, what made this a very good one, a very high probability one, is because on the 15 seconds, it actually gave us a lot more like the antithesis of this model. So if this is a impulse rejection failure, what's the antithesis? Well, the antithesis is when we actually do reject, so an impulse rejection. One of the ways that I've found I could use this, and I'm still trying to develop it further, is by combining the antithesis of the model with the actual model. So in this case, what that looks like is we have this impulse high. We run it, we drop below. Now I'm expecting this to fail. I'm expecting a closure back above. So go to a lower time frame and now look for the opposite to happen. So if we are bullish and I'm expecting this impulse rejection failure to impulse high to fail to reject price, then I want any sell side impulse lows to actually reject price, because that would indicate bullishness. And you can see that playing out here where we drop down, just tick below that impulse low and get the rejection out. Now we get the entry signal for the 1 minute impulse rejection failure after having rejected that 15-second low, making this a great entry. So that would be an entry right there. You just put your stop below the low, like so. So that would be a lovely model right there. That worked out really nicely. And then the next one, as I just mentioned, and I already showed you the SMT between this swing low and that low. That indicates first stage of the market maker model. And when we get to that and we displace up, Another place that I can use this particular model, the impulse rate failure, and this is the most effective way to use it, is when you're expecting speed out of the market. Now in a market maker model, first stage of a market maker model, it's a bit slower. Second stage is when you really get the speed. And when you really get the speed, you can expect entry models that are kind of a bit faster, use a tighter stop to actually play out. This is quite a tight entry model, and this is the perfect place to use it. The examples that I've found are when I can clearly identify first stage of the market maker model, such as that. And then once we break the high that made the SMT manipulation leg, then I can potentially use that model in there on the low time frame. When we zoom in, however, there isn't really much of a clear entry here. Usually what I want to see is let's say I'll draw this fractal out of here, so high, low, and then breaking that high, so that's us breaking above that high there. And usually I'd want to see us pull down and there'd be a short-term low in here that we go below, and then do that. So this would usually be what I'd want to see. And there would be a short-term low just here. And the reason why that is because by breaking that low, that shows sell side delivery, and it's only after we've had sell side delivery and then broken a high, so breaking back above that old high and closing up there, that shows buy side delivery again. You could probably argue that that short-term low right there counts as sell side delivery, and so on the low time frame, but it's just not obvious enough here. However, I would have actually trusted this as a good long opportunity just on this order block. And the reason being is because, for one, I'm looking for that SMT on the lows and for us to then break above that first stage of the market maker model, and then I'm looking for this model to unfold. However, because I'm expecting that model to unfold, if there are other PD arrays and information available that would also suggest that we should hold this area, I don't necessarily need to drill down to a 5-second time frame or whatever to find why I should get in the trade. So at this point, if I can tell that, okay, I'm really bullish, I can see the targets really clearly, and I can see the SMT in the lows, we then drop down and get this rally up. Now, sure, this could just be, oh, we're enticing shorts, running up to take them and dropping back down. But what was giving me confidence is, one, the SMT, but two, this. So if we draw back over to the 15-second time frame, we can see that same impulse rejection. So a short-term low, impulse low on this chart. What makes it impulse low is the fact that it is a swing low that's created before a aggressive run up. So anyone who chased this big green up close candle, they will likely want to put their stop loss down below the swing low. So by dropping down to it and then getting this aggressive run back up, that's telling me that, okay, this is what it looks like. We have actually rated out the lows. We've rejected this low, showing bullishness. We have that SMT, and I'm expecting second stage with high targets. So I could have simply gone like, okay, I trust that this is second stage that we'll get after breaking this high. And at second stage, you anticipate certain frameworks or certain entry models and PD arrays to hold. Anything that pertains to speed and strong order flow. That is things like institutional order flow entry drill, a partial entry into fair value gap, and also propulsion blocks. This is a order block that dug into a previous order block, and that usually propulsion blocks should be super sensitive from the wick down to the open, and definitely you do not want to see it get below the midpoint. If it got below the midpoint, roughly there, of this order block, then that is not a good sign for strong order flow, which I'd be expecting given the context. So that becomes your stop loss. Your stop loss becomes just slightly below the midpoint of that candle. And rather than trying to find a very specific low time frame entry here. Even the 1 minute would have been fine here, but it's just you can't see enough information just here for that. But using just the order block, trusting that that should hold, and if this is indeed second stage, then we should not get down there. So that becomes a beautiful entry there. Notice that it's also at the 80s, that institutional level. We're getting that nice drop below the 80s, and you put your stop loss there. That would have been a lovely run high as well. We have the 200s right here. When we hit the 200s, easily get 20 points above that, even if just scalping. And then we've got 50 points up here. And then you can start looking for, okay, 7 AM high. That would be a great target as well. That is the business there. I'm going to quickly jump over to gold. I haven't looked at gold for a while now. It's 15 seconds on that. So, where are we? I need to remember exactly where we are first. Bring up the hourly open, there we go. So I was watching gold during, here we go. This looks very familiar. Very nice. So, all-time highs are roughly here. There's our all-time high. Let's do that. Shit. So all-time high. What do we do? Well, we opened up on Monday, and then rallied up Monday night. Sorry, so Asia last night hit all-time highs with this big impulsive rally, and then started consolidating. What we're doing here? Well, we're bull flagging. Bull flagging means that we're about to go up again. That's what people look for. Also, big impulsive rally, heaps of time spent at the premium, tapping into all-time highs. Everyone's excited by that breakout. The 500s, we're getting above the 500s. Here's that same dynamic I mentioned earlier on NASDAQ with a institutional level, but essentially running into that level. Everyone wants to buy the breakouts. Everyone gets excited with this bullish move. Everyone's waiting for the next leg up. But it doesn't happen and we roll over. That's something I look for. And the idea is that there's anyone who's buying up here, where are they going to put their stops? They're going to put it here, they're going to put it here, they're going to put it here, or how about below? There's a low. There's a nice swing low for everyone to put their stops at. If they want to be extra safe, they can put it below this low, or how about these lows? So I know there's a lot of liquidity down here. I know that there's a lot of people wanting to buy up here. So what I'm looking for is for us to begin to pull back. And rather than just pulling back, I want to see us continue pulling back until everyone's hopes are dashed. Now, I did not manage to get involved. I took one attempt to get involved and got taken out. And I want to go over what I learned from that and how I could have done it better. But I've just been waiting through this range. I won't go into too much detail over it. I'll mention just a few things that stood out to me. One being the fact that throughout this consolidation, we were unable to retest that all-time high, which is roughly there. And also the 500s, the same dynamic where we failed to reach down to the 23K on NASDAQ. Failing to reach up to that level, anyone who bought up above the high or whatever, unable to get out if they were underwater. Anyone who was buying in here and that was their first target, not given permission to get up to that because people see that as resistance, a great place to exit. We then begin rolling over. At 2 AM it runs up above midnight, sells off aggressively. Now this is where it gets interesting. If you were bullish but you weren't dumb enough to buy up here, what are you waiting for? Well, you're waiting for a pullback into the range. So you're like, okay, well, I'm going to measure out my dealing range from there to there. Okay, there's equilibrium. We're pulling back. Okay, cool. Oh, yep, we're making a low and we're going back up. Yep, that looks strong. Cool. So everyone now wants to buy. What's the idea? Buy the dip. It's the simplest, most profitable strategy known to man. Like that's how you buy. That's how you make money. You buy when it goes down, and then you buy the dip and it goes back up again. So everyone's waiting for the dip. Anyone who didn't buy it through here. Anyone who did buy up through here, they're getting nervous on this drop down. Their stop loss is down here. They might have thought that they were willing to risk $100,000 on this trade, but when it actually comes down to it, they're like, oh, I didn't expect this to lose at all. So it starts going back up, and anyone who had this stop down here, they're probably going to want to trail it. Anyone who wants to buy the dip, they want to buy here and move their stop down to that low. So it becomes a very low probability low to hold. We then spend a bunch of time up in this area. I was surprised we didn't take out this impulse high. I would have liked to see that. But we spend a bunch of time here and then drop aggressively low and break that low. So what's happened here? Well, anyone who's bought up here, anyone who bought here after this rally, they are now underwater. When they are underwater, their stop loss, if they weren't taking out here, their stop loss is down here. The market isn't just going to run back up to the entry, let them out to break even and then go low. It's going to remain heavy. So you want to see it not run all the way back up. One other thing I'll mention before I continue, original consolidation. It just so happens we have two hourly opening prices at the exact same price, which indicates a intent of coming back down to this area, an original consolidation, and that also makes this incredibly high probability to be at the target. What happens then? So we've taken out this low. Anyone who bought up here, they're like, oh shit, this is not good, this is not good, this is not good. It starts climbing back up. I say it in that way because I've felt that way before. But they're basically grappling themselves and getting hopeful. It's beginning to climb back up, really high resistance, slowly but surely. You know, the entry is up here, so they're like, oh, it's coming back, okay, this is good. Oh, that was a close one. The same as on NASDAQ, that sigh of relief. Then what do? Well, we hit this impulse high. Okay, well, what happens when we hit the impulse high? We reject it. So impulse high, rejection low. This should have been my signal that, yep, exactly what I'm expecting to happen is happening. And that would have been a great place to be getting short right in this area. We even have a impulse rejection. And remember what the antithesis is. That is a impulse rejection failure. So if we draw that out, we have a impulse low, drop low, it's climb back above, and then drop below again. Or you could use any one of these lows. It's not as clean because you can't see one particular low to use. But in any case, the narrative is that we have the trap shorts up here. We know the stop's still down there. So even if you were to just use a high time frame idea, go, cool, I trust that we are rejecting this high. That shows that we don't want to come up to here. So I'm just going to sell here and put my stop loss above the high that we are showing an unwillingness to go back to, and then target that low. That could have been a way to do it. Obviously, I can also find these lower time frame entries and tighter things. But what I did wrong was I saw all this happening. I didn't know exactly where to get in, partly because we didn't take out that high, which I was wanting to see happen. And so it wasn't until we got this drop lower and we were very close to our draw, and I started thinking, okay, well, I do want to get in. And I see us run up, consolidating. I'm like, okay, let's see what's going to happen. We're respecting this fair value gap. And then I saw that, okay, well, we ran out this high. We just tapped above it there and then rejected lower hard. And it's like, okay, cool, this looks good. This should be a breakaway gap. We've trapped longs up here with a bull flag. Let's just roll over from here. So I sold here and got stopped out immediately. On this other account, this is a Forex account I was using, I'd also decided to just take one trade a day. So ran up and actually hits this high, rejects low, sells off to our target. I'll show you something cool as well on this chart. If we jump to the 15 seconds, we can do, yeah, I'll do 15-second chart. What I mentioned about the last second wick, that actually happens here quite nicely. So, and it happens on multiple time frames as well. Hold up. So, have this rally up, and then what time is this? This is 3:44 and 45 seconds. So 15 seconds before the close of this 1 minute candle, aggressive drop lower. So we spent the entirety of this 1 minute candle making this big wick right at the highs, and then the last 15 seconds it drops. What time is this? This is also 3:45 a.m., which is the open of a new 15-minute candle, the open of a new 5-minute candle, meaning that we just had a nice big rally going into the close of a 15 and a 5, so was the 1 minute candle. That all shows enticement, and also the fact that we spent the majority of the time at the high before last second dropping lower shows that we're potentially trapping longs. That on top of the fact that we just raided this impulse high, it just gives that really clear narrative. That we then get a long wick plus displacement right there on that candle. All of that narrative together, along with the signature being the fact that we failed to return into this wick and then displaced lower, that right there shows extreme heaviness and would have been a great place to enter right there as well. But yeah, that is that model. I was thinking I should actually go into my entry models. I'll bring it up even. I'll just show it to you here. So Control F, sell the dip. So this is the sequence of events I wrote out after today, so that I'd be able to capture, well, I'm getting lost, capture this move. So I want to hit this low, and I'm expecting the dip to happen, but just to keep on dipping. That's what this model is. It's a dip that just keeps on dipping until it takes out whoever was trying to buy it. So framework, sell the dip. The traders are enticed to buy a pullback after an enticing rally. So after a big rally and we start pulling back, and now the traders are enticed to buy, but the pullback just keeps on pulling back, and you short against trapped pullback longs. Sequence of events. This is the important parts that will allow me to capture this in future. So firstly, apparent pullback begins after an enticing rally. Okay, I'll screenshot this and put it on the trading view chart. So apparent pullback begins. So we start pulling back. Everyone's thinking, okay, going to buy the dip and then capture the continuation. False pullback entices, false pullback low entices dip buyers. So we create a low and then start rolling higher. So now everyone who wants to buy the dip, they want to get long right here. Bunch of time above that low, so that traps the longs. So all this times, everyone's buying, and then breaks back down. Pullback buyers are now underwater. So in this area here, everyone who bought up from the highs, they're now underwater. Anticipates a failure swing / remain heavy and look for rejection. That's what this is. We anticipate this high to not get taken out. I want to see some sign that that is the case, that we're not going to take out this high, that we have an unwillingness to go back up there, such as this impulse high rejection, and then look for rejection, and then you just short against the trap pullback long. So that is the sequence of events. Now, going back from my lesson on NASDAQ today, where I actually missed my A+ trade because I had a specific sequence of events, I think I need to be able to identify when a model is incredibly high probability, and maybe we won't get this low in this pullback. So rather than waiting for that, I might actually have a way or a different model that would allow me to get in if we were incredibly heavy and just tanking. So recognizing when different situations and A+ situations unfold, so that I don't miss a trade because of a sequence of events. But I think having a sequence of events really is something that's going to help a lot of my trading and my frameworks, help me trade them better. While I'm looking at this model, I'll mention where that was on NASDAQ today. and that was here. Same situation. We have this big old bull flag, bullish news. Everyone's trying to buy at the highs. Where are the stops? Well, you could say down below this low, sure. But we go straight to that, and then we start pulling back. Everyone who saw this big rally, everyone who saw this big move up here, and we're buying this bull flag, they are now either buying the dip, or if they already bought up here, they're trailing their stop loss there. We have a little rally, very small mind you, but then this enticing green move upwards at 11 a.m. drops straight back down. That indicates that this is essentially the same model. We have traps longs and breaking back down, and this is not the kind of dip you want to buy, and it just gets rolled over. So potentially there could have been a way to get involved on the short side right in this area using that same kind of framework. Best trade that I actually did catch today, because I didn't just take losers today. I did take a nice demo one. I don't even know where I am. Here we go. So one trade I took a long right here. I liked the fact that we have that same last second wick forming right here. It's always a manipulation closure. Sorry, too many concepts I'm going over. Manipulation closure is when we already read a low, get that close back below, which you would think would indicate that we'd failed to reject, but then the very next candle rips straight back up. That indicates that, okay, this is a manipulation closure, meaning it's a long-term low. Then if you look at this time, this is 4:56 a.m., 4:57, 8, 9, 5 a.m. In the last 4 minutes of this hourly candle, sure the low of the hourly candle was here, but we made this low and then ripped up into the close, meaning that this wick was engineered last second. So I trusted that combined with this made this a really nice 5-minute impulse rejection, and so I wanted to buy. I bought up here at the 5 a.m. candle, and it's pulled back quite deep. I had my stop loss right there, so it just fell short of it. I immediately knew that it shouldn't be there, it should be at ERL. It then runs up and then consolidates and drops down to take out that deep discount internal range liquidity once again before ripping higher. So that took me out. My stop loss should have been down here. We then run up, take out this impulse high, so we've got trap shorts above this high. We tap into it right there, begin rejecting lower. We have this nice, the same thing I mentioned before, impulse high, impulse rejection. The antithesis is the impulse rejection failure. So now we're looking for us to fail to reject this impulse low. We trade below it, we close back below, that becomes a short and it sells off. Now, because I'm still bullish, I was looking for a long 5 minutes low, expecting that to be an impulse rejection. We drop into it, have this nice wick, high resistance, run into it, run back out of it, and I bought there anticipating that this low should remain intact, and that's because we have the 7 a.m. open, 7 a.m. Judas swing lower. A lot of the time the turn will come around 7:30, and once we have clear bullish order flow post halfway into the hour, I expect that the low or high of the hour to be in. So we have a Judas lower, and I'm expecting the hour to close green. That's actually 7:31 right there, so 7:30 is here. Post 7:30 we are showing bullish order flow, so I bought with a stop loss at the low and caught this nice run up, took off half at the 7 a.m. open, took off another piece here, held a runner and then walked away from the chart because it was just demo and got stopped out in this pullback, but slash reversal. That was a cool trade. I don't have MP5 open, can't be bothered bringing it up. But that is the winner that I actually did take today. And other than all the correct ideas I had. So I've got heaps of frameworks that are, beautiful frameworks. They work really well. But as I mentioned, they're just little things in my execution and my thought processes and mental frameworks that are just making me make little mistakes, or such as this in this case. Um, uh, I'm missing the trade not because I didn't know that this was a good long. It's because I have been experiencing over trading recently, and I wanted to make darn well sure today that I would not do that again with this fresh account. And so I intentionally avoided this, thinking I was doing the right thing by waiting for this sequence of events for this framework. But in future, I'm going to be able to recognize where, especially this is the key, this framework, the 830 no soup. But when all these things are in confluence and I'm incredibly confident with the trade, I need to allow myself the room to use my intuition and my experience to be able to take a long here and trust that we'll get this nice short squeeze without without saying, no, I have to wait for step 1, then step 2, then step 3. That will do for my review. This is the only model I'm going to be taking on this account. I'm only going to be taking one execution per day. There's only going to be one singular entry. There won't be I'm not scaling into anything. I'm only taking one entry. I'm taking maximum 3 different exits. And that is the only thing I'm going to be doing on this 50k account. So starting off down $243 in the account, but I can easily bring that back, and I'm pretty confident that I'll be able to show some consistency in this account using this model. So excited for what's ahead.